What if I told you that while everyone's celebrating stock market highs and thinking there's nothing wrong with the economy, that a very real liquidity crisis, on top of that a massive dollar shortage, is brewing right underneath the Fed's watch? And I'm talking about something the market can't see. It's an immediate liquidity drought that's already flashing red alerts in the shadows of Wall Street. And this is an urgent wake-up call because we've seen liquidity crisis morph into all-out bear markets. Now stick around because I'm about to reveal why the Fed's about to declare an emergency on Wednesday, why they don't have the tools to stop it, and why you can't afford to ignore it. Plus, I want to give a shout out to one of my former sponsors, Black Box Stocks. You can find them on the NASDAQ on the symbol BLBX, and their stock went on to rally over 450% after being featured on my show back in July of last year. Now, stay tuned to the end for their latest updates because they're making some big moves, and you don't want to miss out again. Now, right now, money markets have been flashing warnings for several weeks that the process known as quantitative tightening may have run its course. Now, there's two issues here. Banks and money market funds are turning to the Fed for overnight loans to get cash. Now, how they're doing this is they're pledging treasuries and mortgage-backed securities as collateral. But here's the other side of it. Money dealers who provide liquidity in the repo markets, they don't want to lend right now. And this is what's happening as financial conditions are tightening. It's a direct sign of that. It also indicates that dollars are starting to get scarce. Now, there are other warning signs that this liquidity issue is much bigger than the stock market realizes. A variety of interest rates used among banks to borrow and lend to each other have risen. Even the Fed's benchmark rate, which is seen as less sensitive to liquidity conditions, has ticked higher within this range for the first time in 2 years. So we've got another two issues here, because when banks don't want to lend to each other, that overnight rate rises, and this is a sign of financial stress. Now the question is, why would they? Because think about this. We've been talking about Tricolor and First Brands, their bankruptcies, and then on top of that, what happened after? Jamie Dimon, the CEO of JP Morgan Chase, he came out and said, look, if you think this is minor, there are a lot of cockroaches sitting on bank balance sheets. So what you're seeing here is banks are nervous about lending to other banks. And in the past, they've been borrowing at the lower end of the federal funds rate, but now they're borrowing at the higher end. And what this is signs of persistent money market tightness. It's an indication of a dollar shortage. It's all telling us that a liquidity crisis is brewing and it's about to spiral out of control. And if we take a look at the Fed's standing repo facility, it's seen increased usage, as you can see on this chart, jumping now to $6.5 billion in a single day. So what you're seeing from this facility is the Fed is acting as a lender of last resort because nobody else wants to. Now, for many on Wall Street, the Fed will need to move fast if it wants to avoid the kind of distortions that rocked money markets back in September 19. And back then, short-term rates skyrocketed. And what happened? The Fed ended up cutting rates and implementing QE. Now, stocks dropped a little bit after that, but the Fed continued to make sure there was sufficient liquidity in the markets. So what I want you to understand is when banks need cash, they pull back on their risky lending activities. And back then, and just as they don't want now, the Fed doesn't want to see margin calls. Because when we look at the latest data from FINRA as of September of this year, there's $1.13 trillion in margin loans that are supporting stock prices right now. So imagine this. What if the market's ignoring these risks and the Fed's tools don't work and liquidity dries up even further and the banks say, look, we got to force the sale of this to get our money back? It will send the stock market into a deep contraction, and right now, nobody wants that. In fact, as stocks sell, guess what people get? They get dollars. It only makes the situation worse. So in addition to a 25 basis point rate cut at the next meeting, many large banks are expecting the Fed to end QT at the October meeting. And let's take a look this time because I want you to see why I don't think the Fed will be able to rescue the banking system and the markets. Now, right now, Wall Street is trying to frame this as just a plumbing issue within the financial system. There's really nothing to worry about. It's just a mere technical hiccup with reserves dropping below $3 trillion. And this is really simple. The Fed can fix this problem by ending QT just as soon as next week. But here's the contrarian truth, my friends. The real risk is a dollar shortage is starting to appear. And I think it's far bigger than the Fed can handle. Now, if you're looking to put some extra money in your pockets, we put the odds in your favor when it comes to trading. Let me show you this optimized trade we put out to our CTA Timer Pro subscribers back on the 15th. We told them to buy on the open PHO. That trade now at 1.06%. But I said we're changing the game because what I have done is I've taken all of my strategies and I've optimized them on a per security basis. That allows us to back test them and give our subscribers even more information. And what we've seen on our back test, that every time this signal trips, it has a 100% win rate with a 3% average positive expected return. And right now this trade is on day 7, looking to hit those numbers again as it's up in today's trading. Now, if you're looking at trading or you're not even sure you can, I put a video in the link below. All you have to do is jump on there. I'm going to show you step by step how to use my reports so you can make more money trading than you ever have. And once you're ready, grab those links in the description below and be sure to use a coupon code for your free 30-day trial. Now again, we go back to 2019, there was just a mild drop in the stock market, and that will pale into comparison to what we will see this time if forced selling begins. We're talking about an all-out liquidity-fueled firestorm. Now let's dive into why this liquidity crunch could be even more explosive than 2019. Because right now, the U.S. banking system reserves, which are a key factor in the Federal Reserve's decision to keep shrinking its balance sheet, just tumbled for the second straight week further below the $3 trillion mark, just as the central bank is set to determine its path for its balance sheet. Now, I want you to think back to the global financial crisis, because after that, the Fed determined one of the reasons we had a crisis is because there were insufficient reserves in the system. Now, if you're wondering, well, what is a bank reserve? Well, it's actually just cash. In fact, it's cash that was swapped into the banking system through quantitative easing by the Fed. The Fed gives the banks cash, and in exchange, the banks give on collateral a treasury or mortgage-backed security. Now, that cash that the Fed gives the banks, it's got to stay inside the banking system. But here's something that's really shocking, because while the Fed's saying we need a minimum amount of reserves, prior to the global financial crisis, as you can see on this chart, the level of reserves was, well, 0. But all of a sudden, we do need reserves, according to the Fed. And that drop comes at the time the Treasury has ramped up debt issuance to rebuild its cash balance following the increase in the debt ceiling in July. And that's drained liquidity from other liabilities on the Fed's ledger, like the central bank's overnight reverse repurchase agreement facility and bank reserves. So here's what you're really seeing is happening inside the plumbing of the financial system, is that the deficits of the government are growing too fast relative to the actual economy. And so the problem here is the private sector, it's not creating enough cash for both the private sector's needs and the government's borrowing needs. And guess who gets priority? Well, it's the government. So either at this point, we need to see the economy expand, or the government needs to cut its deficit spending, and fast. And right now, neither appear likely. So as we look to the stock market saying, look, at all-time highs, everything must be A-OK. But yet when we start to look at the plumbing of the financial system, it's continuing to show signs that it's running out of money. And it's not just domestic plumbing, because we've talked about how everybody is short the dollar in the currency markets. And that number, and this is the real risk that I'm seeing, I think it's too big for the Fed to stop when the short covering begins, because what happens when traders scramble, they're all going to want greenbacks. Because betting against the dollar has been the dominant trade this year in the tune of the $9.6 trillion a day foreign exchange markets. And the risk here is, again, if this trade comes unwound, the demand for dollars is going to skyrocket overnight. And the Fed, they don't have that kind of money to stop it. Now, I want to understand why Wednesday's FOMC press conference will be one of the most closely watched announcements in a long time. Now, it's widely anticipated we're going to get a quarter-point reduction in the U.S. federal funds rate, but it's not just a cut in the funds rate. Everybody's going to want to know about QT and maybe the restart of QE. Because Fed Chair Jerome Powell said last week that the balance sheet runoff will stop when bank reserves are somewhat above the level policymakers judge to be consistent with quote-unquote ample. So the question is, are we going to get a rate cut in the end of QT, or are they just going to announce that QT is going to end in a couple of months? Because my concern here, and I know this is Powell's concern as well, he doesn't want to spook the equity markets. Because think of this, if there's an imminent halt to QT, and maybe you get a big unwind in this dollar short trade, what happens is there isn't enough money to cover it. Now, the problem is, as I come back to, the government's demand for cash right now is outpacing both the private sector's ability to create enough cash for both. And we can see this is evident in the 2-10s yield curve, because what it's telling us is that financial conditions are tightening. When we get a bull steepener, as you can see above that horizontal black line, what it's telling us is that growth and inflation expectations are coming down. In fact, what the yield curve is predicting, although not very timely, it's saying that a recession is imminent. And could this be on the back of the biggest dollar shortage in history? I think it can. Because again, as money dries up, those who have it want to hold it. And that's the problem. And that's why you're seeing the Fed's emergency facilities, because they're trying to cover the shortfall here, and the Fed doesn't have answers. In fact, my big concern is all the Fed's tools may be inadequate to cover this massive dollar short squeeze to the tune of, again, what could be several $1 trillion. And this could spur a crash in risk assets, a surge in the dollar, and run the risk of an all-out financial crisis. So right now, this week's FOMC meeting is primed for a 25 basis point cut and the announcement of the end of QT, whether it's at that meeting or in the months to come. Now, if liquidity floods back into the market, again, this would be a fantastic thing if it happened, then the Fed can notch another win and say, look, we did what we needed to do. But I want you to keep an eye out, because if the Fed's emergency standing repo facility continues to get used and interbank lending rates continue to rise, it means we're facing a risk of a monster dollar rally that could unwind several $1 trillion worth of global dollar short positions. And this would trigger an unprecedented demand for dollars far bigger than the Fed can even handle. And if there's a liquidity crisis, it won't just mean stocks are going to crash. Jobs are going to be lost. Businesses are going to fail because they can't get the money they need to make payroll. Banks, they're going to face insolvencies, and we've seen this before. Now, here's what you need to do right now to protect your wealth. I want you to monitor the plumbing of the banking system post-FOMC. Stay tuned, because we're going to be covering that every week. And I want you to rotate your portfolio into defensives. I want you to be thinking about long dollar, long treasury positions here. And if you want to hang on to your other positions, like your tech stocks, your crypto, your gold, that's fine. There's nothing wrong with that. But I want you to think about hedging some of that downside risk, because if this blows up, you're going to have the one thing everybody wants, and that's dollars, and you're going to be able to buy the dip like you've never been able to buy before. And this is going to turn one of the biggest crises into real dollars and real money in your pocket. And speaking of something else that everybody wants, that's rare earths. And let's turn to black box stocks. So you find them again on the NASDAQ symbol BLBX for an update. Because right now, China dominates the rare earth supply chain, controlling about 70% of global mining and up to 90% of processing. And even though the U.S. and China are on the cusp of a trade deal, the future supply of rare earths is going to be a focus for the years to come. But here's the good news. Companies are fighting back to build secure, Western-aligned alternatives. And black box stocks right now is looking to merge with RE Alloys, who's on fire securing non-Chinese sources. In fact, they just signed an MOU for up to 40% of high-grade rare earths from Brazil's Azaxa project with St. George Mining, a 10-year LOI granting 15% of Tanbree's output via Critical Metals Corp, and even roped in GM's defense president as our new chairman. And how about this? The strategic pact with Japan's Jogbek for tech transfers and investments to supercharge U.S. and Japan supply chains. BLBX is one to watch, and one that should be on your hot list. And as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades, and use your risk control levels when you do. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.